to monitor cash flow. Companies then offer consumers advances based on those cash flow patterns and recoup advance funds from account balances. Overdraft avoidance companies can monetize this service through membership fees, interchange fees, or directly through employers. Other overdraft avoidance companies monetize through so-called voluntary tips. These products have become popular with hourly workers who live paycheck to paycheck because it offers additional liquidity between paydays. Critics of this service argue the products should be regulated as loans and be subject to lending laws, including an APR requirement. Consumer advocates have been particularly critical of the tipping model and question whether a tip influences a consumer's likelihood of being offered in advance. The emergence of these products raises larger questions about consumer cash flow needs. Policymakers have taken some actions in response to these questions. The California Department of Financial Protection and Innovation took action against several buy now, pay later companies and issued a legal opinion classifying these products as loans. The CFPB also released a blog post encouraging consumers to be keenly aware of the details of these products before choosing them. Additionally, the New York Department of Financial Services led a multi-state investigation of a number of earned wage access and overdraft avoidance companies to determine whether they had violated state lending laws. Today, we have a distinguished panel of witnesses who will be able to discuss these issues more deeply. Throughout this hearing, I hope to dive deeper into these products and explore the merits and risks that they raise. The true nature of these products and the implications for borrowers engaging in unsustainable borrowing patterns. With that, I would like to recognize my friend and ranking member. The gentleman is now recognized, Warren Davidson is now recognized for 5 minutes for his opening statement.
Thank you, Chairman Lynch, and thanks for our witnesses and the work that you've done in advance to make sure we have a great discussion today. We're talking about buy now and pay later, but frankly, this is just the whole concept of credit. Fintech didn't create the concept of credit, but the focus will, of course, be on what has changed in light of this Fintech innovation. What is innovative going on in the marketplace? You know, the exceptional growth and popularity of programs such as buy now, pay later, earned wage access, overdraft avoidance products, exemplify some of the benefits that Fintech has brought to consumers in recent years. Today's hearing will assist this task force in understanding just how and why these products are becoming preferred over traditional financial products that also extend credit. Until we gather a sound understanding of these products and how they are used, we should refrain from implementing burdensome regulations that would overly impede consumers from receiving the benefits that the programs bring. It's important to recognize just how far these products, or really access to credit, have evolved over the past several years. According to a Forbes article from last month, the percentage of Gen Zers in the U.S. using buy now, pay later, for instance, has grown sixfold from 6% in 2019 to 36% in 2021. Millennials' use of buy now, pay later has more than doubled. Meanwhile, Gen Xers' adoption has more than tripled. Additionally, according to a Mercatus study in 2020, we already have millions of workers using earned wage access programs. It's estimated that the total addressable market is around 45 million workers, with many of these individuals working in the gig economy. I would note that often it seems the employers are the ones extending credit to the employer as they have actually worked the hours. Lastly, in the midst of the pandemic, we saw many banks migrate away from overdraft fees and adopt overdraft avoidance tools, such as up-to-the-minute notifications and grace periods to repay a negative balance. With these developments in mind, we cannot deny that there is a strong market demand for the products. Consumers are undoubtedly deriving more benefits from the financial services industry than they were just a few years ago. The access to short-term liquidity is easier now more than ever, thanks to technology and advancement, more ways to access credit. Which demographics are more inclined to use these products? Do these products help address the unbanked or underbanked? How are these products affecting small businesses and our macro economy? I'm confident that this hearing can provide clarity on some of these issues, given a range of witnesses that we have here today, but it's important to note that we must exercise caution before we take regulatory action against products. In some products, we may need to overtly protect. The exponential growth of these alternative financial products clearly shows that consumers want them. So we should do two things. We should avoid doing two things. We should avoid punishing new products for not fitting within regulatory buckets that were already built, and we should clarify how they would fit in this current regulatory scheme. We should avoid overly impairing consumer choices on how they spend money, and we should facilitate innovation. Does this mean that I'm advocating for a completely hands-off approach? Certainly not. As I say often, I'm a Republican, not an anarchist. But if there is a harm that the products impose on consumers, then hopefully this hearing can lay out the problem and help us find a way to solve it. Proactively legislating or promulgating rules always runs the risk of failing to adequately address the problem. In fact, many times it addresses a problem that isn't there. Conversely, failing to address known problems really puts a heavy burden on our regulators, and often we see regulation by enforcement in the market, which punishes innovation and fails to protect consumers. Lastly, I would just reiterate the importance of protecting consumer data as we continue to adopt these new financial technologies. As many probably remember, consumer data privacy was the prime focus of our task force's last hearing. I encourage my colleagues to always keep in mind anytime we are discussing new financial products where consumers are providing sensitive information. I'm sure we will continue to discuss these topics further within the committee as alternative financial products become more widely adopted and innovation continues to flourish here in America. This hearing will hopefully serve as groundwork for future hearings, and I look forward to the discussion with our witnesses on the range of issues. I yield back.
The gentleman yields back. Today, the ranking member and I welcome the testimony of our distinguished witnesses. First, we have Dr. Kristen Brody, who is a fellow at the Brookings Metropolitan Policy Program at the Brookings Institution. Next, we have Ms. Penny Lee, the CEO of Financial Technology Association. We also have Ms. Lauren Saunders, the Associate Director with the National Consumer Law Center. And we have Ms. Marissa Bell Torres joining us virtually. Ms. Torres is the Director of California Policy with the Center for Responsible Lending. And lastly, we welcome Mr. Brian Tate, the CEO and President of the Innovative Payments Association. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer in front of you somewhere, or on the screen, or on the desk in front of you, that will indicate how much time you have left. I'd like to ask you to be mindful of the timer so that we can be respectful of both the witnesses and the committee members' time without objection. Your written statements are already made part of the record. Dr. Brody, you are now welcome to offer a 5-minute summary of your presentation of your testimony. Thank you.
Good morning, Chairman Lynch and members of the Task Force on Financial Technology. I am Kristen Brody, and I am a fellow in the Brookings Metropolitan Policy Program. Thank you for the opportunity to appear before you to discuss consumer lending products offered by technology-focused fintech companies. Financial technology companies can mitigate racial, financial, health, and wealth gaps that hamper Black and Hispanic families' financial security through product offerings and policies they put in place. Through technology and automation, they can reduce costs and prices, speed up delivery, and increase convenience for underserved populations. Over the past 20 years, fintech companies have provided new ways to capture data, reach broader audiences, and expand access to credit. These companies also have the potential to think differently about policies and programming that can amplify opportunities for Black and other minority communities. These private sector innovations can be paired with public policy interventions, as well as address some of the systemic issues that have contributed to the financial health and wealth gap. Fintech companies can create inclusive financial services products for people who are credit invisibles or low credit individuals. For example, fintech companies can smooth and stabilize cash flow by collaborating with enterprise, financially vulnerable populations experience greater income and expense volatility. Offering accounts that do not have overdraft fees, minimum balance requirements, and account maintenance fees can help reduce the negative impacts of this volatility. They can provide interest-free buy now, pay later capabilities so that consumers can comfortably make purchases and spread out payments as they get paid. Klarna's buy now, pay later option is an example of this. It allows customers to split the cost of their purchase into 4 smaller payments without paying any interest or impacting their credit score. This allows consumers the ability to try items before they pay for them and only pay for items that they keep. Further, with respect to saving and investing, fintech companies can help Americans build emergency savings. According to an AARP national survey of U.S. adults aged 30 and older, 3 in 5 African Americans experienced an unexpected financial challenge in the past year. A study by EPI found that in 2016, half of families had no retirement savings at all, and that disparities existed by race. 2/3 or 68% of white, non-Hispanic families had retirement savings, compared to 41% of Black families and 35% of Hispanic families. To increase the saving ability of Black and Hispanic families, fintech companies can offer high-yield savings accounts, automated savings features, and robo and micro investing tools to increase savings opportunities. They can use alternative data and machine learning to extend affordable credit to a larger population of consumers. They can provide fast, fair, and flexible small business lending products that do not require a personal credit score. We know that Black and Hispanic people are likely to have lower credit scores than white people would, which means that these companies are helping them to build saving and buy products that they need. They can focus on access to capital through a racial equity lens. In addition to being deliberate in how small business credit products meet the needs of Black-owned small businesses, they can capitalize on opportunities to work with government stakeholders and provide a fintech perspective so that as laws and regulations are updated, they reflect the changing landscape of financial services. Fintech companies can offer products that bridge the gap between cash and traditional financial services that empower people to participate in the digital economy. They can hire more people of color, particularly Black people, as we see banks leaving Black neighborhoods and Black people having less access to traditional banking products. They can meet people where they are, in their communities, working more intentionally with local leaders, MDIs, and CDFIs. They can partner with banks that are focused on racial equity at a time that we see racial equity disappearing from the banking industry. They can engage with people of color in their communities, in churches, in sororities, work with HBCUs and minority-serving institutions to increase financial literacy so that these underserved populations have a better idea of what their products are and what they have to offer. With respect to public policy, they can take steps to increase financial health by increasing investments in CDFIs. They can create mandatory financial curriculum for middle and high schoolers to help educate people earlier. Thank you.
Thank you. Next, Ms. Lee, you're welcome to offer a summation of your testimony.
Thank
5
you.
minutes.
Thank you, Chair Lynch, Ranking Member Davidson, and members of the Task Force on Financial Technology for the opportunity to testify before you today on innovations in financial services that are empowering consumers and businesses with greater choice, opportunity, and access. My name is Penny Lee, and I'm the Chief Executive Officer of the Financial Technology Association, FTA, a nonprofit trade association representing some of the world's leading technology-centered financial services. We educate consumers, regulators, policymakers such as yourself, and third-party industry stakeholders on the value of trusted digital financial services and advocate for the modernization of financial regulation to support innovation and promote inclusion. We are in a transitional time when technology allows financial services to be more accessible and facilitate faster and easier transactions. Consumers and businesses are shifting to modern, check-driven solutions to manage their payments, facilitate transactions, secure a loan, track expenses, and access capital. If anyone had a meal, medicine, or groceries delivered during the pandemic, that was likely took place over financial technology or a fintech platform. By using internet and mobile platforms, machine learning, automation, and other emerging technologies, fintech companies are providing consumers with improved personalized services, greater convenience, increased transparency, reduced cost, and broader access to capital for individuals and businesses. These advances are coming at a critical time for the American economy. Millions remain underbanked and underserved and lack access to fair credit. Student debt continues to mount, income and wealth inequality continues to grow, and small businesses seek to rebuild from the devastation caused by the COVID-19 pandemic. Fortunately, fintech solutions offer a new paradigm and are reshaping the financial landscape in powerful ways. I will focus my remarks today on a particular area of the fintech innovation, which is called Buy Now, Pay Later, the BNPL space. FTA is pleased to count many of the global leaders in BNPL as founding members of the organization. There is a shift in how consumers, especially millennials, Gen Z, and others, are spending their money. They are saving more and utilizing credit cards less, preferring debit cards with no fees or revolving interest. Buy Now, Pay Later is an alternative payment method that allows for small, short-term purchases that are typically paid in interest-free installments. BNPL products are structured to have payment terms that require consumers to pay for a purchase in a matter of weeks or a few months. This is in contrast to revolving credit and high-interest products that may take years to pay down, blur the true cost of a purchase, and oftentimes keeps consumers in a vicious cycle of debt due to continuous interest charges and rollovers. BNPL products are preferred by consumers for several reasons. One, they charge little or no interest fees, unlike credit cards, which can sometimes cost consumers up to 225% of their product purchase value in interest expenses. They are transparent and provide greater cost certainty for consumers. They help users budget and, as a result, help manage cash flow better and avoid risky debt products. They are flexible and offer more relief when consumers face an unexpected emergency. And they typically result in less debt, and repayment takes place over much shorter terms. BNPL products are regulated. They are subject to key consumer protection laws and regulations, including anti-money laundering, fair lending, credit reporting, debt collection, privacy, fair treatment of customers, and electronic fund transfers. They are also subject to similar state consumer protection laws. Our members are committed to regulatory frameworks that safeguard consumers and are actively engaged with financial regulators, such as the CFPB, in this pursuit. FTA appreciates the opportunity to engage with the committee today and views this as just the start of an ongoing dialogue. Fintech innovation, including BNPL solutions, is driving competition and choice for consumers that result in lower cost and better financial outcomes. We believe strongly that balanced and thoughtful regulation is key to long-term success for all involved stakeholders, including providers, consumers, and merchants utilizing new payment systems. We look forward to helping inform this important process. Thank you.
Thank you, Ms. Lee. Ms. Saunders, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you. Chairman Lynch, Ranking Member Davidson, and members of the task force, thank you for inviting me to testify. I'm here today on behalf of the low-income clients of the National Consumer Law Center, which works for economic justice for low-income and vulnerable consumers. We are seeing an explosion of products that claim to help people manage gaps between income and expenses. Some, if well-designed, can help meet consumers' needs, but some are designed to evade consumer protection laws or fall outside of critical consumer protection laws. Funding or liquidity provided today—
Ms. Saunders, could I ask you just to move that microphone a little closer to your— Yeah, thank you.
Funding or liquidity provided today that is repaid later is credit. Even if clothed in shiny fintech garb, new credit products need basic consumer protections for credit to ensure that it is affordable, responsible, transparent, and fair. Buy Now, Pay Later products may help consumers manage larger purchases without the long-term debt and high costs of credit cards. When they operate as promoted, they can be a win-win. But multiple loans can be difficult to manage and can lead to unaffordable debt loads. Abusive profit models may be built on late fees from struggling consumers. Refunds may be difficult to obtain if there is a problem with the item or service financed. Earned wage access products are a form of payday loan. Funds advanced ahead of payday, repaid on payday, even if they are generally lower cost and less dangerous than traditional payday loans. Most employees reborrow every pay period, and fees can add up and increase with charges for instant access. In the end, low-wage workers may simply be paying to be paid. The trend is for employers and payroll providers to offer free early pay, and free early wage access, repaid through payroll, used occasionally, may help manage cash flow, but more study is needed. One of the more deceptive and evasive forms of credit I have seen is the use of purportedly voluntary tips. The tips model is spreading and is used in fake earned wage access apps like EarnIn, which have no connection to employers, supposedly overdraft fee-free forms of overdraft credit on non-bank deposit accounts like Chime, cash advance features on other non-banking apps like MoneyLion and Dave, and platforms like Solo Funds that purport to be mirror arrangers of peer-to-peer loans. Tips are a disguised form of interest. Companies have ways of pushing people into tipping. Access may be restricted. Default tips may be difficult to undo. When caught using one method of pressuring tips, another will surface. All the tip products I just listed are balloon payment loans that undoubtedly lead to a cycle of reborrowing. Just like the $15 charge on a conventional $100 payday loan, tips on Fintech payday loans may seem small, but can add up to high dollar amounts and high APRs that can reach 200% or higher. Notably, products that claim not to be credit may also deny being subject to the Equal Credit Opportunity Act. As we reckon with systemic racism and the impact of new technologies, we must not countenance evasions of our fair lending laws. We must also keep a close eye on how products evolve, as products may not stay free or low cost, or the ultimate business model may be different than it appears. My recommendations are: financing and liquidity products are and should be subject to federal and state lending laws. Regulators should closely examine and crack down on evasive pricing models. All forms of credit should be based on ability to repay, and those that are not may be unfair, deceptive, or abusive. Point-of-sale credit should have the same chargeback rates, reasonable penalty fees, ability to repay, and statements that credit cards have. The CFPB should begin examining providers of Fintech credit products. And regulators should look out for inappropriate use of consumers' data and for disparate impacts. Thank you for inviting me to testify. I look forward to your questions.
Thank you, Ms. Saunders. Ms. Torres, you're now recognized for 5 minutes for a presentation of your testimony.
Thank you. Good morning, Chairman Lynch, Ranking Member Davidson, members of the task force, and members of the committee. My name is Marisabel Torres, and I am Director of California Policy at the Center for Responsible Lending. Thank you for the opportunity to testify in today's hearing. As a Latina who is first generation, my immigrant parents did not come to this country equipped with knowledge of the U.S. financial system. I have seen firsthand how easily people can be preyed upon with credit offers that may promise financial opportunity, but that can result in financial harms. As a consumer advocate who has worked on policy issues around financial inclusion, including predatory inclusion, I know that my family's experience was not unique. Our discussion today is timely. The availability of fintech products and services is increasing as many consumers face tightened household budgets and heightened financial insecurity in the wake of a health crisis with dire economic consequences. More consumers may be looking for financial help after forbearance periods expire and stimulus payments have ended. Lenders who offer seemingly low cost or even free credit are well poised to capture this market share. But while these products may appear straightforward, consumers and policymakers must ask themselves, what is the catch? We need data to understand what they are, their prevalence, and whether further protections are needed. The testimony I have submitted for the record details our concerns with products including buy now, pay later, earned wage access, and so-called overdraft avoidance products. My oral testimony will focus on buy now, pay later. In my state of California, the previous commissioner of our financial regulator, the Department of Financial Protection and Innovation, discovered that by offering these products to California consumers, certain buy now, pay later providers were making them illegally without license to make loans in this state. On this basis, DFPI brought enforcement actions against them and required their licensing in California. Because they were licensed, DFPI was able to begin gathering data. We are awaiting public disclosure of key points, but at a minimum, we know that the take-up of these products has exploded in California. Of the loans that DFPI has published data on, the top 6 buy now, pay later lenders accounted for nearly 11 million, or 91% of the total consumer loans originated in 2020. If there are problems, their impact will be felt on a wide scale. As described by recent surveys of buy now, pay later users, there are a number of issues identified with the surge in this lending. More providers are entering this market, and we cannot delay their examination to fully understand the impact on consumers. There are signs that borrowers who miss payments may be racking up late fees at a high rate. A Credit Karma study found that of the 1,000 users surveyed, 1/3 reported they had fallen behind in all payments. Of those people, over half said their credit scores had declined thereafter. Not all of the buy now, pay later providers will pull credit to determine a consumer's ability to pay, but those that do will also report missed payments to a credit bureau, so these products can lead to damaged credit. As with payday loans, buy now, pay later requires the user to give lenders access to a bank account or a credit card to withdraw payment. This can lead to problems such as overdraft, not having sufficient funds to cover the payment, and the inability to pay other bills. These products are also targeting and attracting younger consumers. As we saw with credit cards being pushed on college campuses, this can saddle young people with debt, starting their journey into adulthood with damaged credit and potential for lifelong negative financial consequences. There is also concern that the entire business model of buy now, pay later rests on driving borrowers to purchase items they would not otherwise buy. Finally, these products are algorithmically driven. We can assume that they will be subject to inevitable algorithmic bias. It is therefore vital that they be subject to regulatory examination to see if there are fair lending and related concerns. This all reinforces the need for the Consumer Financial Protection Bureau to use its authority to identify and address the risks that they pose to consumers. CFPB should collect data and move towards supervision of these products. Thank you again for letting me be part of this discussion. I look forward to your questions.
Thank you, Ms. Torres. Mr. Tate, welcome. You are now invited to offer a 5-minute summation of your testimony.
Chairman Lynch, Ranking Member Davidson, and members of the Task Force on Financial Technology. My name is Brian Tate. I'm the President and CEO of the Innovative Payments Association. It is my privilege to appear before you today to share the IPA's views on emerging fintech cash flow products with specific emphasis on the use of earned wage access. IPA is a nonprofit trade association that serves as the leading voice of the electronic payment sector, including prepaid products, mobile wallets, and P2P payments. IPA's mission is to encourage efficient use of electronic payments, cultivate financial inclusion, and empower consumers. As we have learned through the pandemic, even the best laid plans cannot always protect families from unexpected financial disruptions. The Federal Reserve's 2018 survey of household economics found that 40% of American households would struggle to come up with $400 to pay for an unexpected bill. Many consumers have few options should they face an unexpected expense between paydays, and the traditional options have proven to be expensive. The U.S. Department of Labor reports nearly 2/3 of U.S. businesses pay their workers on a biweekly, semi-monthly, or monthly schedule, which means that workers are, in essence, giving their employers an interest-free loan. A study by the Financial Health Network found that 38% of respondents reported timing mismatches between wage income and expenses. During the past 10 years, the payment innovators have developed new services and products to help consumers meet these timing mismatches. One of the most practical and affordable options is earned wage access, or EWA. Simply put, EWA programs allow consumers to access their own money prior to payday. Getting paid daily is not a new concept. Many Americans, including waitstaff, taxi drivers, bartenders, can get paid at the close of their shifts. The two former leaders of the Consumer Financial Protection Bureau, Directors Cordray and Kraninger, didn't agree on much, but both took concrete steps to support EWA. Director Cordray exempted employer-sponsored programs from his 2017 payday lending rule, and Director Kraninger issued an advisory opinion explaining that certain EWA programs are simply not credit. IPA agrees with both Cordray and Kraninger and maintains that EWA products are not loans or credit products. Therefore, they should not be subject to TILA. The Financial Health Network's report on EWA found consumers in financial distress may consider title, payday, or pawn loans as options, with the average cost per EWA transaction ranging from $2.59 to $6.27. The report makes it clear that EWA is far less costly than other options. EWA has grown in popularity because it is safer, cheaper, and more efficient alternative to other short-term products on the market. EWA providers do not impact customers' credit ratings, and they do not share information to credit reporting bureaus. EWA is offered with no recourse, and providers have no rights against the user in the event of non-payment, loss of employment, closed accounts, or blocked payments. These are non-recourse transactions, which means the risk of loss is on the provider. As someone who has been working since the age of 14, I can easily relate to a retail worker, single parent, or young adult facing a financial emergency and lacking easy access to short-term liquidity. At different points in my life, I have walked in the same shoes as millions of Americans who find themselves unable to pay for a utility bill, child care, or an unexpected medical expense. Treating EWA as credit would be a mistake and remove a valuable tool from consumers' financial toolkit. Thank you for the opportunity to present the views of the IPA, and I welcome any questions the task force may have.
Thank you, Mr. Tate. I'll now recognize myself for 5 minutes for questions. This is an interesting dilemma because we often on this committee, the wider committee, especially Chairwoman Waters and the ranking member, often talk about banking the unbanked, right? Or underbanked. So here we have a suite of services or products that you have to admit they seem to be going not entirely at the cohort that we're interested in, but they are going at younger consumers who have a thin credit file or no credit history at all. And so they're sort of going at the problem, but yet in many respects, and I know this has been brought up by Ms. Torres and Ms. Brody and Ms. Saunders, that the buy now, pay later providers don't necessarily share the credit transactions or the credit history with credit rating agencies, and so we don't have all the data that we'd desire. And ironically, data flows so seamlessly in this industry. It's ironic that the only data that's not flowing is the flowing to the credit agencies that might actually help some of these consumers with thin credit files. But what are we seeing out there? I know that a number of you had testimony about the situation in Australia, where I assume that the adoption rate is a little bit more robust than it is here in the United States. I think they got an earlier start because of some of their regulatory framework. But what are we seeing right now in terms of defaults, late fees, late payment penalties? What are we seeing in this space, especially compared to, I guess, the more onerous payday lending products that are out there, or high interest rate credit cards? Ms. Brody, do we have any data on that?
I do not.
Okay. Ms. Saunders.
So I set this out in my testimony. One survey done for Credit Karma found that 34% of people who had tried a buy now, pay later loan had fallen behind on one or more of their installment payments. In the United Kingdom, one bank found that 10% of customers who made a payment to one of the two large providers had overdrawn their account beyond the amount that they were allowed to overdraw. There's one provider, Afterpay in Australia, had 20% of their revenue from late fees. So, we do have, troubling indications that there are a number of consumers who are late, who may be struggling. And I am also worried whether some of the providers may be building their profit models on those late fees.
Right, and there is a lack of data from some of these providers. Ms. Torres, do you have anything you want to add on that? Any other data that we're getting?
Yes, I would say that related to what Ms. Saunders brought up, of those Credit Karma users who were the Credit Karma survey participants, they did mention that of those people who had fallen behind on payments, 72% also reported that they had seen a hit to their credit, which is also a pretty concerning rate.
Let me ask then, would it be helpful if Congress, if we introduced legislation that would require these buy now, pay later and alternative financing methods to actually report their credit histories to the credit rating agencies? Would that be helpful? At least it would give us a richer, a more granular credit history on these consumer patterns. Ms. Brody?
We are urging that, oh, sorry.
I'm sorry, Ms. Torres, go ahead, I'm sorry.
Sorry, I thought that was a follow-up. We are urging that CFPB use its supervisory powers to collect data to get a better understanding of what the consumer experience actually is among all of the users of these products, especially because, as you mentioned, it has been mentioned, they are skewing younger and might be more consumers who are not as familiar with the credit system as other seasoned users might be.
Okay, and that's what's California's doing?
So California has licensed them as lenders, so they are able to take in data. And so this is the first year that we have had data related to exactly what the volume is, but we're not sure exactly about what the user experience is, which is why we're asking CFPB to supervise and analyze the data to get a better picture view, not just at this state level.
Okay, thank you. And Ms. Saunders, do you have anything to add to that in terms of any efforts to get a more granular look at some of these borrowing patterns?
Right. Well, I definitely support, CFPB's supervision and data collection. I think it's worth considering whether they should be reporting to credit bureaus. But I also think it's a misconception that most of these users don't have credit or thin score. I think a lot of them do or could. And certainly, Dr. Brody mentioned cash flow underwriting. There are plenty of ways to become eligible for traditional credit. But lending without ability to pay is not the best way to do that.
Okay, thank you. I've exhausted my time. I now recognize the ranking member, the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Ms. Lee, when I started thinking about this hearing, as I started buy now, pay later is simply the idea of extending credit. That's been around way before the internet. But, as we think about the payment systems today, could you briefly explain why this is different than payment options that have been around for years, maybe as far back as the innovation of the pencil?
Sure. So it is fundamentally different, and a lot of that has changed because of the technology in which we're able to facilitate many of these transactions or have these relationships. A lot of people want to put the analogy to a layaway program, and it is different in that it is an alternative method in which to make payments. And, unlike the past in which you went directly to a merchant to be able to, sign your contract as far as on a layaway, you now have a fintech platform that is facilitating both from a merchant standpoint and from a consumer standpoint. These are products that are designed for low interest, no fees, to be able to have consumers be able to make their payments within their own budgetary needs. And so it gives the consumer the power. It puts them back into kind of how they want the flexible payment to be able to fit their needs in which they're performing. So it's something that, it is fundamentally different in that it is not a revolving debt situation. It is one in which they want to satisfy their obligations in a very timely and a short period of time.
Yep, thank you for that. And timing is one of the biggest things in the amount of automation. And in general, there's a third party involved that's providing the service versus, going to the general store, signing in the book behind the counter. I saw that on Little House on the Prairie, I think. So the innovation in the technologies made it so much more accessible. Who's using BNPL products?
As Esben has alluded to, it is millennials are predominantly along with Gen Z, but we're starting to see it in other generational cohorts as well. And these are individuals, right now millennials, 2 out of 3 do not own a credit card. They prefer debit cards. They prefer to have the control of their own pocketbook within access to their own bank accounts. So that is who's predominantly using it. 85% of users using BNPL use a debit card on that and not credit card, which again inflates the overall cost. It gives them certainty, it gives them the ability to budget, and it gives them the ability to pay within their own means. They're usually drawing every 2 weeks. Usually these are done off of America. We usually pay people every 2 weeks, and so it allows them to have that flexibility to meet what their payroll needs are as well. And so in the UK, most people get paid once a month, so it's usually a pay in 3. So it's a very different model in that sense, but it's giving consumers that flexibility to be able to meet and budget these needs in a time frame in which they prefer.
Yep. Thank you for the summary. Mr. Tate, when I think about earned wage access programs, I remember one of my first jobs working in a restaurant. I was a high school student. I was at school or practice when the bank was open. I would work at night when I had time. And then often in the morning of Saturday, back in the day, the bank was open, but I would have a meet or a game or something like that. So it was hard to get to the bank. So I had this piece of paper when we got real paychecks, but I didn't have money. And so it was hard to have access to that. Thankfully today, with the age of the internet, you can deposit this stuff online. You have internet banking, but you still have needs to access the wages because the wages haven't there. Could you explain how earned wage access is working? And I'd say just if you could also mention how, and you touched on it in your opening statement, but where we're at from the CFPB and their treatment of earned wage access.
Well, first, we have similar backgrounds. I was in my teenage years and was a busboy as my first job. So really quickly, EWA is, the way it works is generally speaking, especially if you fall under the framework of the CFPB, is that a EWA provider will partner with an employer. The employer should do their due diligence and find out the right provider for them. And when they make that service available after they have an agreement, it is voluntary. They cannot compel an employee to use it. It's made, generally speaking, again, if you fall under the framework, it should be no fees for the transaction itself, although the CFPB permits a subscription fee. There should be, your calculations are based on accrued wages, so the money you've earned up into that point in the pay period. There is no debt collection, and there's no recourse. And so there's very confined kind of limited space for those agreements to take place. Many of those agreements through the employer are made free in many cases or at very low cost. Some are even cheap as $1. And if a need should arise, the employee can then voluntarily participate in the program, and the provider will make those funds that have accrued available.
Thank you for the summary. My time has expired. Thanks for all the witnesses and your explanation. I look forward to the rest of the hearing, and I yield.
Gentleman yields. The chair now recognizes the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. My first question is for Mr. Tate. Can you use earned wage access to access your income on a daily basis?
In some cases, yes. There are a wide variety of programs and providers on the market, so there is no one-size-fits-all.
But it could be, in theory, okay. If I heard your testimony correctly, the fee per transaction could exceed $6?
It could. There are some that do, but
okay.
According to the Financial Health Network, that is the range. And again, as I mentioned,
but I just want to move on if I can.
There is a wide majority.
I want to move on if I.
Products.
I'm going to reclaim my time. So $6 is the high. If you're a low-wage worker earning a minimum wage of $7.25 an hour, then that fee is almost an hour's worth of work. It's almost 1/8 of an 8-hour workday. That strikes me as excessive. Does that not strike you as excessive?
No, if it's Tuesday and I've worked a week and a half and have accrued wages and have a flat tire or I need to go to the store, I'm not sure why I have to wait till Friday to make that happen.
I'm referencing the fee, but let's move on. I have a question for Ms. Lee. The Austrian Finance Industry Association has adopted a code of conduct for buy now, pay later companies, a code of conduct that governs matters such as late fees and minimum wage. Does the American Trade Association for buy now, pay later companies have its own code of conduct?
We are working with CFPB, and we have been in active conversations with them and hold our members up to it.
But you don't have one yet?
We are brand new as a trade association.
Okay. Mr. Tate, does the American Trade Association for Earned Wage Access Companies have its own code of conduct?
I'm not familiar with the American, that trade association.
No, is there a trade association for earned wage access companies? Or?
We represent, but whatever the title you said.
Do you have a code of conduct?
No, we do not.
Okay. Ms. Lee, what should the minimum age be for a customer who uses buy now, pay later financial products?
The FTA's buy now, pay later, I believe, have a minimum at 18 right now. Is the average is 18 to 34 is who is using the product right now.
Could you legally use the product below the age of 18?
I'll have to double check on that.
Okay, but would you support regulations that require a minimum age of 18 and older? Or?
I will confirm with our members as to if there is a minimum wage.
No, what should the minimum age be?
I will refer to the members.
Okay, because you said we should advocate for thoughtful and balanced regulations.
I said on the average, the average cohort right now is between 18 and 35, and I will double check with the members as if they have set a minimum age.
Okay, but I'm asking your opinion about what should the regulation be.
I will refer to the members on that.
Is buy now, pay later a loan?
In California, it has been designated as a loan. It depends. Different jurisdictions verify it. Or
do you think it should be classified as a loan, as a general matter?
It is an extension of credit, and it is a payment alternative program that allows people to be able to pay for a good in their own time.
But if
that's an extension of credit.
If I spend
and in different jurisdictions, it's described as a loan.
But if I spend your money now and then I pay you back with my money later, common sense would dictate that I'm borrowing from you and that you're lending to me. If it looks like a duck and swims like a duck and quacks like a duck, then it's probably a duck. Mr. Tate, I'll ask this question to Ms. Lee. If a consumer pays on time and in full, buy now, pay later companies do not typically report payments to credit rating bureaus. But if a consumer fails to pay on time and in full, then those same companies might report non-payment to credit rating bureaus. Is it fair to report one without reporting the other?
FTA members that are in the BNPL space do not report either side. They are actively working with credit bureaus right now because they do not. Right now, the credit bureaus are trying to figure out how this data collection works and be able to model accordingly. Traditionally, credit bureaus have used credit based off of monthly pulls for longer-term loans, such as mortgages, student loans.
So I'm going to interrupt you. I want to make sure I heard you correctly. There are no BNPL companies that report non-payment?
There are some that engage with it.
Would you characterize that as unfair, to do one without the other?
We want to work with the credit bureaus to make sure that they do capture those that pay on time in a regular payment, because we do think that it is an ability to help provide good credit when someone that is paying consistently for 2 weeks on a minimum time.
And I see my time has expired, but I think you said earlier that buy now, pay later leads to more saving, but there was a Cardify AI survey suggesting that buy now, pay later shoppers increase their spending by 10 to more than 40%. Is there a concern that the buy now, pay later product might cause consumers to live beyond their means and potentially take on unsustainable debt? Or
yeah, and they are using those because of the certainty. They know exactly what the cost is going to be. They're not incurring increased interest fees. They're not they're not incurring additional cost. And so they're using these products because it gives them a certainty. They know exactly when the payments are due, and 97% of those people using buy now, pay later products do not incur a late fee. So it gives them that consistency in being able to budget better within their own means.
My time has expired, but thank you.
The gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes and 30 seconds.
Mr. Chairman, thank you very much, and thank you for this very worthy, insightful hearing, and to hear our panel provide us their ideas. Mr. Tate, I would like to see if you have an opinion about something that has been an issue, the Earned Wage Access program. And previously, we've had CFPB directors who viewed this favorably, and it presumptively was a positive part of the ability for people to use this. I wondered if you had an opinion about this and the success of the model and how it's, and what you think of it. Questions for Mr. Tate.
Sorry, I'm sorry. I had to turn my microphone on. Back in
Yes, sir, and I apologize. If you did not hear the question, I should have said Mr. Tate earlier, so then you'd be, did you hear my question, Mr.
Yes,
Tate,
sir.
about the earned wage access? Thank you, sir.
To answer your question, back in 2017, Director Cordray, when he released what is now known as the payday rule, set aside provisions within that rule, earned wage access products, as a way, as an alternative, and then he laid kind of a framework or a foundation for these products to thrive and grow. And Director Kraninger, in 2020, when she issued an advisory opinion, expanded on the groundwork that Director Cordray laid back in 2017. And in fact, Director Cordray, when he released the rule, I guess gave a speech or made a statement, which is on the CFPB's website today, talking about how these products are a positive thing for people. And also, I have a quote here. The rule also excludes from coverage some new fintech innovations, such as certain no-cost advances and programs to advance earned wages when offered by employers or their business partners. And again, in 2020, Director Kraninger kind of built upon that and then said and made it clear that even if you don't fall within the framework of the advisory opinion, it said that they would take a totality of the circumstance view of each product and provider and make a determination on their own. And just because you are not within the framework does not per se make you credit. So I think that together, they didn't agree on much, but I think together they have expanded this product, which is, as you mentioned, very popular. I think there are about 45 to 55 million users here. And if you read the Financial Health Network's report or Mercator's report or KMPG's report, they all talk about how this product is significantly less than alternatives that are out there on the market.
Mr. Tate, thank you very much. This is the kind of feedback that I believe helps the committee to recognize that programs like this actually help people that it was intended for. And that was insightful. And Mr. Chairman, I want to thank you for not only having this hearing, but actually vetting out not just the CFPB, but also people who are in the marketplace to give opinions about the effectiveness of what we're trying to do. And that is to help consumers with a balance, but also to make sure that the net comes out with an advantage overall for the consumer in this process. Mr. Chairman, Mr. Tate, I want to thank you very much. Ms. Lee, thank you for your performance today. Mr. Chairman, I yield back my time.
The gentleman yields back. The chair is very pleased to recognize the chairwoman for the full committee who has been working on this issue for a very, very, very long time. The chair recognizes the gentlelady from California, Ms. Waters, for 5 minutes.
Thank you so very much. I appreciate the opportunity to share a few remarks maybe and ask a question or so. Ms. Saunders and Ms. Torres, earned wage access allows employees to access part of their earned income immediately without them having to wait until the end of the pay period. To me, this sounds very similar to a payday loan. However, it seems that the CFPB, under former Director Kraninger, did not agree. In late 2020, the CFPB issued an advisory opinion that stated that certain EWA products were not credited under the Truth in Lending Act. Earned wage access may create a cycle of unsustainable borrowing as employees who should be paid a viable wage borrow on their own hard-earned income and are forced to pay additional fees to access their income. I fear that the underlying problem is the fact that too many employees are not paid a livable wage. Earned wage access products have been developed by Fintechs, but it seems that their basic business model is less about innovation and more about evasion. Do you think it is a priority for the new CFPB director, Robert Chopra, to revisit the advisory opinion? Or do you think that earned wage access should be treated as credit? And how can you tell us how earned wage access users, who are oftentimes working class hourly workers, are affected by the lack of TILA protections in particular?
I'll start. Yes, I do think that the CFPB should revisit the opinion issued under Director Kraninger. What happened under Torres, he was addressing the horrible abuses of conventional payday loans, and this, was a different product that posed less, although still significant concerns. But evasions of credit laws are incredibly important to stop, and this does create a cycle of reborrowing, and if you can't pay an expense this week, you just have a hole in the next week, and that causes fees, and as Congressman Torres said, that could be an hour or more of low-wage workers' pay.
Thank you very much, and I appreciate the opportunity. I yield back.
The gentlelady yields back. The chair now recognizes the gentleman from Missouri, Mr. Lukenmeyer, for 5 minutes.
Thank you, Mr. Chairman. Interesting hearing today, and Ms. Lee, I want to thank you for your testimony today. You indicate that, Mr. Tate a while ago made a comment in his testimony that the Federal Reserve had a study that said almost 40% of Americans could not cover a $400 emergency tonight. So I go home tonight and my refrigerator is out. It takes, anywhere from $800 to $1,000 to go buy a new refrigerator. I've got 2 kids at home, and I've got to have them be able to have something to eat tonight and tomorrow for breakfast and the next evening as well. And so I've got to have a refrigerator. So I go someplace, and for them to be able to sell me this, I may have to, give them $200 today and $200 the next week or 2 weeks and so on. And, your comments are that it empowers the individual to make decisions on what they want to do. They can do without, or they can go borrow from some money from someplace else, or they can go use this method of payment, pay now, buy now, pay later, and they need control. This gives them the control to make that decision, gives them the flexibility to help with their budgeting. And you indicated that 97% of the people experience no late fee. Is that correct? Did I hear you correctly on that?
That is correct.
So in other words, 97% of the people use these products and this method of purchasing things and paying for things in an appropriate manner.
Correct.
Ms. Saunders continues to talk about all the abuse that's going on, and I'm kind of curious, do you know what percentage of that 3% that are late are abused by late fees?
If I'm hearing your question correctly, it is on the revenue model of a BNPL. Less than 15% of their revenues are attached to a late fee. So these are not models. These are that reward late fees or incurring reoccurring debt. These are BNPL products help consumers have a flexible payment option that have clear and assignable payment periods that they can meet. It is in their interest for them to meet these payment requirements so that they can use this product over and over again.
Okay, my point is that only 3% of people even experience a late fee, and how many of those are abused by companies? I would think that that'd be a pretty small figure of that 3%. Now, I'm not condoning those folks; they shouldn't be doing that. We should be finding a way to punish them and keep that from happening. But I think let's don't overblow the problem here and throw the baby out with the bathwater, and that this is a very, very good way of allowing people to purchase products, pay for them in a timely manner as they can afford them.
And I would just say one thing also to understand about the mechanics behind is when someone does miss a payment or have a late payment, their account is immediately paused. They are not able to participate in any more buy now, pay later products on their service or not have that service provided to them again. until they rectify or till they satisfy that original obligation. So it is not something that is trying to reward more buying power when you cannot meet the minimum payments. It is trying to design people to have clear and assignable and accurate payment methods accountable to what their pay periods might be.
Well, I think that it brings up the question of what responsibility does the consumer bear with repaying a debt, with repaying a buy now, pay later situation. I mean, they made the decision to purchase something in this manner. The responsibility falls on them, does it not?
Yes, it does.
And we shouldn't be penalizing the people who are trying to sell products and services in that manner. Also, I think one of the things pointed out, and I think the chairman did a good job with this today with regards to some folks who are, 97% of the people who are paying on time and making their payments appropriately don't seem to be getting credit for that with the credit bureau. And you're indicating that your association is working with the credit bureau to see if this can be done. We do this with utilities and rent. I know on this committee over the last several years, we've added those things to credit bureau files for people to be able to have reported on them. So when they do make timely payments, they're given credit for that. I think that's something that we need to be continuing to work on. And would you just elaborate a little bit more on that, please?
Yeah, no, we applaud the efforts to modernize credit bureaus and are working with them actively so that they can properly assess and analyze what this data that we would be sending them. This is data that would be coming into them.
So let me interrupt. My time's about out. Apologize. So are you talking about us having to legislatively tell people when you implement a program like this, you're going to have to automatically report, or are the credit bureaus working with the different business entities and different associations say, hey, we want to work with you to be able to help the consumers be able to utilize these products?
It would be in the latter. Private companies actively working with credit bureaus so they understand kind of what this data is saying, how the consumers are using it, what it means for somebody to be paying $25 every 4 weeks or every 2 weeks over the course of 4 to 6 to 8 weeks. What that means for them from a credit perspective is someone that is consistently paying on time, not incurring late fees, how that can be positive aspect for how someone could build credit. And so we want to make sure that they're capturing that data correctly and that it can be seen as a positive, that it's not being seen as a negative pull just because of the frequency in which they're using these products. So it is, these are new products coming onto the marketplace. We want to ensure that the credit bureaus understand them properly so that they do not do harm to the consumers, but yet actually add to the overall positive credit history.
I thank you for that, and I encourage your association to continue to work with the credit bureaus to make sure that folks can have their successful use of these products reported as well. Thank you, Mr. Chairman. I'll yield back.
The gentleman yields back. The chair now recognizes the gentleman from Wisconsin, Mr. Stile, for 5 minutes.
Thank you very much, Mr. Chairman. We're experiencing a labor crisis in the United States. You can drive almost anywhere. My drive to the airport to come out to Washington, D.C., you see help wanted signs. There's a mismatch in our economy right now between the 10 million jobs that are available and getting workers back to work. I think it's something that we should spend a lot of time digging into. This is an interesting hearing, in particular, as we look at the ability of EWA to really kind of alter some of the labor market. Mr. Tate, I'm curious of the role that EWA products can play in encouraging worker participation in improving employee retention, where we can actually better connect the work and labor of an individual to the quick payout. I'm often thinking of a waiter or a waitress, a bartender, has quick access to their cash. They can actually flex how much money they make by maybe picking up an extra shift, working a Friday night, a Saturday night. That's hard work, but you get to walk home at the end of that shift with money in your pocket. Different if you're working for some of the largest companies in the United States. You don't have that opportunity to walk out the door by picking up an extra shift and putting money in your pocket. I'm thinking you might know you have a bill due on Monday. You might have a need for some extra cash as people are going out and doing Christmas shopping. You want to pick up an extra shift, but you might not have that ability to pull that cash forward to be able to benefit from the labor that you did that weekend so you can knock out some Christmas shopping maybe on Sunday. Can you comment on how EWA services are provided through some of these employee partnerships with the employers and whether or not it has an impact on employee retention?
Certainly. So I agree with my colleague down on the panel, Ms. Brody, when she touched on bringing financial services to people where they are. And I think technology allows us to do that in ways that we couldn't conceive 5 or 10 years ago. Everything that I have read and the companies that I have talked to, this is used, as you mentioned, as a tool to retain employees. It helps them manage their money, helps them smooth out income volatility. I also think at the same time, this is a dignity and empowerment tool. I think this is a way for people to take more control of their money and allow them to make decisions in real time, again, in need, if something were to come up, which I have certainly experienced. I think the conversation in mind that we're all having today about all of these products, specifically on EWA, we should be keeping the consumer in mind and what would you do in those places, and we should be giving those consumers more tools to manage their day-to-day financial needs.
So to dive in, earlier you were being asked questions about what the fees range from. What the top end you said was around $7. What's the low end?
It's in some cases, in a lot of cases, it is free. If it's
so it's free. So that means somebody ultimately is footing that bill, but it would often then be the employer that's viewing this as value additive to their workers.
Absolutely.
In that structure.
And in many cases, this is a popular benefit, and you can see in the future where you can see a worker or employee, a potential employee thinking, gee, company A doesn't have EWA and company B doesn't, and so I'm going to go to the company that has the EWA option.
Maybe,
that is one of many factors.
And maybe for the same reason, some people are attracted to certain service industries that are tip heavy. Going
Correct.
back to my example, working in a restaurant, I used to work at an Applebee's, I worked at an Olive Garden. You walk away at the end of that shift with money in your pocket, but this gives other types of employers that opportunity to directly connect the work and the labor that's being provided by an individual with that payment. Let me shift gears, if I can, with you, Mr. Tate. One of the concerns would, of course, be what happens if an employee pulls that money forward and then, for whatever reason, life changes, they leave the job, and, holy smokes, would they be on the hook for this money that's pulled forward?
The employer?
The employee, the employer, good luck for that person. I'm concerned about the worker.
So these are no recourse products, especially if you're fitting within the CFPB's framework that was developed by Director Cordray.
So there's no risk to the employee that they're going to be on the hook for pulling a wage forward?
No. Similar to the numbers on Buy Now, Pay Later, it's 97% recovery, and that is reported in Mercator and as well as the Financial Health Network. And so
I think that's an important point, and you and I know that, but I don't think that everybody fully appreciates that, because I think in your head you're thinking this is probably a recourse loan as it wants to be portrayed, but it's not. It's a non-recourse, and it's not a loan. I think that's just a really important point to walk away with. You're familiar with the CFPB's issued their advisory opinion last year that EWA services are not credit, exactly what you're saying.
Correct.
Can you further explain the CFPB's stance on this briefly?
Well, when they issued the advisory opinion, they were building on the principles laid out or that was set aside in the payday rule in 2017 by Director Cordray. Director Kraninger expands upon that, but if you read the commentary and kind of the footnotes in those conversations when they lay out what fits in the framework, they also make it clear again that they're taking a totality of the circumstance test. So in essence, they are allowing variations of the framework they're putting in place, because I can't put myself in their shoes, but I would assume that they recognize that we're in a marketplace with lots of innovation. I don't know what new products are going to come out next week or next year.
I appreciate your time, cognizant of the clock. I appreciate all of you being here. I wish I had time to dive into additional questions. Mr. Chairman, with that, I will yield back.
The gentleman yields back. Chair now recognizes himself for 5 minutes. And I would like to talk about the earned wage access piece. So I was an iron worker for about 20 years. Worked mostly for steel erectors, but it was customary in our industry that we worked Monday through Friday, and then payday was the following Wednesday. So in my business, the ironworking industry, we had what we call a drag. You could actually get what you call now, earned wage access. You could get no more than a couple of $100 in advance of your payday the following week. In my situation, however, I was a member of a union, so we had union protections that were between myself and my employer and the bank, so that I had added reassurance and I had recourse to make sure that I was treated fairly. I'm just curious, in some of these low-wage industries where there are not those protections. Is there a conflict? And I know it seems like this is an employer decision as to which fintech they choose to deal with, which platform, if you will, and the terms of payment are various. The arrangements that are made here. I'm just curious: is there a danger where the employee is not part of this conversation regarding the terms on which that early wage access might be gained? Is there a danger that their interests may be harmed in that agreement between the employer and the fintech company that's going to conduct this? Ms. Saunders, any views on that?
Well, I am concerned about companies having a hard time competing in their providers. I know that there are some that offer these programs for free, and they have a hard time competing against ones that charge the employer, and some employers would rather have the low-wage worker pay.
Okay. That
concerns me.
All right. Well, let me jump into something else. You know, lately we've been hearing about some of the big players getting involved here. Visa is looking at the amount of money that's being generated, diverted from the traditional banking system. MasterCard, some of the other big players getting involved in the buy now, pay later space. There seems to be more going on here. There's cross-selling, the importance of that data itself. What other implications might there be with respect to, and we had Mr. Chopra in from the CFPB last week, and he wanted to ask Amazon and Apple and others regarding their data collection on the financial services side. So are there some issues that we should be cognizant of or actively investigating with respect to how consumer data is being used in this context, Ms. Saunders?
Yes, absolutely. Anytime consumers' data is being collected, we want to make sure that it's in ways that consumers would expect, that they would approve of. And I am concerned that some of these models that look great, they look, too good to be true. Well, are they really vehicles to collect data, to pitch other products? Are they something different than what they appear? And it's always important to know what the real business model is and how data is being used.
Ms. Brody, do you know of are there any limitations in terms of how that data is gathered and used in this space?
So these companies use data and algorithms to measure how people are going to pay, but it doesn't affect their credit score like it does for payday lenders or credit cards. So of course we have to have some type of data, but this data doesn't stay on your credit report and affect it for 7 to 10 years like a FICO score would.
Yeah. Okay. Ms. Torres?
Yes, I think that to be aware of is that this data can be used to push other products onto a consumer who might not have been looking for that product in the first place. And so it's another way to maybe try to entice, through the cross-selling of products, consumers to assume more debt that they might not be able to handle or that they weren't looking for in the first place.
Ms. Lee?
FTA's BNPL players only share consumer data with merchants for the fulfillment of an order.
Okay. And Mr. Tate? Just any concerns regarding the use of data, especially with some of these big players getting into the space?
Not that I'm aware of, no.
Okay, thank you. My time has expired. I now recognize the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. And I'm glad we get an extra round to ask some questions here. And just, Ms. Torres, just to react to one of your comments, cross-selling, I love cross-selling. I go to Amazon. Jeff Bezos built a heck of a company because, hey, if I like this, I might like that. I mean, that's one of the best uses of data if the information can be protected and kept private. And the privacy concerns, I think, need to be paramount. For our whole economy, one of the most important things Congress could do would be to pass an updated privacy law. Within just the jurisdiction here, I was just so encouraged by our last hearing on financial privacy because there are a lot of things that go on there. So, Ms. Lee, when the idea, I mean, you go back to, cartoon days, probably everyone has heard the phrase, "I'll gladly pay you Tuesday for a hamburger today." That's an extension of credit. No one's making, you don't have to give the hamburger. It's just an offer. It's a service that's provided. Now, some people go from personally lending a friend at no cost or say, I'll give you $100, give me back 110 next week. And no one does the math, it's just a simple fee. Then you formalize it and go from, I did that for a friend or two, maybe I'll just start a business. How does somebody get into this business? Do you have to launch a bank? Can you get into this space just applying the technology? And then what are the obligations to protect consumer privacy if you do set up a business in this space?
Yeah, I would say it's probably not as easy as just as creating the burger stand, but a little bit more complexity. And there are a lot of players in this space already, I would say, and it does require you to be adherent to federal laws, state consumer protection laws, a whole host of regulations that are there to protect the consumer. So it would require, a tremendous amount of product design, the capabilities, the relationships to have with lending partners, banks and others, and to have those relationships with merchants, and along with then going out and building a product to entice consumers to be able to use this product in a responsible manner. So there's a whole host of different things. It's not just something that you can turnkey overnight. These are sophisticated, the members in which I work with are very large, sophisticated companies, but what they're doing is providing that service and that means and making it easier. So the early analogy, there's that platform, as we're all now more mobile, as we're all more digital, as we're using our payment systems on the click of a button, they're being able to talk to merchants and consumers so people can have both the certainty of when that payment is occurring and know that it's going to be, that payment is going to be taken in a responsible manner. Merchants also have that comfort in knowing that that platform allows them to also receive payment for their purchase, or for their product. So it's an ecosystem that is large. It can be complex, but one that technology is allowing us to have.
Yeah, so I think you made the point that it's not that there's no laws. There are laws that all these businesses would have to be subject to, and frankly, they also have a duty of care with the data. Yes. They would potentially face liability for inappropriate use or breach, things like that. We should clarify some of our laws. And one of the things that I think we try to force everything that's innovative into something that's in the past, instead of often doing the work here to update the framework. So when you think about alternative remittance systems, I think of like the Hawala network. In America, our system is not really built around that, but it's certainly permissible to do it. That doesn't mean you're exempt from money service business laws or know your customer requirements if you're in that business, but it operates differently in terms of how the payments are due, to whom they're due, and whether information moves or the cash moves. All that happens. So how would you say you could explain, yes, we are compliant with some laws, but we shouldn't be treated as if we're payday lenders, or should you? Or when should somebody?
Sure. Well, I would say that we're fundamentally different. Payday lenders are enticing people to, or not enticing, but they have products that are built for people to have a long-term debt cycle, that they have high interest rates, that are competing in revolving debt that takes years oftentimes to pay off, whereas buy now, pay later is satisfying that obligation in a very short time matter with low fees, zero interest, to be able to have the consumers have that flexibility. So fundamentally, two very, very different products and should not be treated as such.
Thank you. My time's expired, and I really appreciate the time given to prepare for this and the hearing.
I thank the gentleman. The gentleman yields back. The chair now recognizes the chairwoman for the full committee, Ms. Waters, for 5 minutes.
Thank you very much. I'd like to direct this question to Dr. Brody. I'm interested in how low and moderate income consumers and borrowers of color in particular are using these emerging fintech consumer loan products. Buy now, pay later allows a consumer to buy and take immediate possession of an item while paying for it over a period of time. While I'm hopeful that emerging fintech products can offer assistance, I'm concerned that some of these new entities may not be providing consumers with clear disclosures about the terms and conditions of these new products, as is typically required for extensions of credit under the Truth in Lending Act. Additionally, as many buy now, pay later products do not report payments. I wonder, what does this mean in relationship to credit bureaus and whether or not they're reported or how that is handled? And so let me just say that some of these products that I'm hearing about are similar to products that were used years ago. There was something that was familiar to the Black community called layaway plans. And with the layaway plans, you would see an item that you'd like to have, you cannot afford it, you would pay something down on it, and then you would continue paying for it until it was paid for, and then you would get the item. I don't think you got it ahead of time. And of course, we're familiar with the old installment loan payments that we used to do when families wanted to buy a refrigerator or something they could not afford. They would get the refrigerator. It would be on installment loans. You would pay something down, and you pay every month until you pay it out. Now, some of these sound like convenient ways to get things done. But what I'm interested in is this. Because of the wealth gap in the Black community, we have oftentimes paid an awful lot of money in order to get some products that we desperately needed. Some of the money was hidden because the products we were buying were way overpriced anyway. The televisions, the refrigerators, and all of that. And I guess now what we're looking at, the possibility of buy now, pay later, but there may be some interest charges here somewhere. Tell me what you know about all of this, and what do you think about it?
So a couple of differences. One, payday lenders and layaway plans and things like that can be targeted to Black neighborhoods. We know that payday lenders are overrepresented in Black neighborhoods, where the programs that you're speaking about aren't targeted. They're on the internet. Everyone has access to them, so they're not targeted towards a specific population. In that way, they're not as predatory as payday lenders. The second thing is that they do provide people with the ability to buy things that they need in an emergency without charging said interest that's associated with payday lenders. So in that way, you can get something and you can get it immediately while you're still paying for it. If you don't finish paying for it, then there's no real penalty to it. It's not like the interest that keeps accruing. So you get the product, you pay for it. If you don't pay for it, then you don't get to use that particular system again. So the penalty really is with the company that's providing the loan, not as much with the consumer like with payday lenders.
I'm interested in your thinking that products are not targeted. Targeting is absolutely ways by which sales are done, communities are identified, communities are excluded. So what do you mean?
I would say
they're not targeted.
They're not targeted in the same way as payday lenders who literally set up a brick and mortar place, a place of business in a Black neighborhood.
How do you know that?
I did my dissertation on payday lenders, so I know how they target.
But I'm talking about the other products that you say now are widely, targeted rather than especially targeted. Targeting is a process that is used on the internet in so many different ways. And so when you say that it's not targeted to certain communities, certain products, I'm interested in knowing, how do you know that?
I would simply say it's not in the same way as locating in a particular area, that they can target based on what you searched for or things that you've looked at online, but they're not setting up in a particular neighborhood based on who's located there like payday lenders would.
Well, I question that, but anyhow, the idea that we need the Consumer Financial Protection Bureau to look at all these products so that we can understand them and know what we're buying, know what we're paying, know where the hidden fees are and all of that. So I appreciate your information, but I do recommend that we get the Consumer Financial Protection Bureau looking deeply at all of these. I yield back, and thank you very much.
The gentlelady yields back. Just following up on that, Ms. Brody, a lender can target people within credit files, and in a way that does, target a certain demographic, right?
Yes, sir.
Not geographic, but a demographic.
Yes.
Okay, thank you. The chair now recognizes the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Buy now, pay later companies typically charge fees to merchants, but not to consumers at the point of sale. But buy now, but pay later companies do charge late fees to consumers who fail to pay on time and in full. My question for you, Ms. Lee, is if there were only fees to merchants, but no late fees to consumers, would the buy now, pay later companies remain profitable?
I would say yes, and that is what their modeling is based off of. Right now, we have 45 million users in the United States spending this last year about $21 billion. Now, that might seem like really large numbers, but it's also only 2% of the overall online retail spend. So there is a lot of growth to occur, but yes, that is a revenue model on charging just merchants fees to be successful.
And Ms. Saunders, do you have research on the extent to which BNPL companies depend on late fees to be profitable?
I don't, but I do know that some observers of the market have pointed out that merchant fees may go down with competition, and so I'm worried that costs may shift more to consumers.
Ms. Lee, I want to revisit a question I asked you because I was puzzled by the resistance to answering what I thought was a straightforward question. Should there be a minimum age requirement for the use of buy now, pay later financial products?
I would say we all, many of the FTA's companies that I represent do have a minimum of not allowing anybody under the age of 18. And so these are standards that will, I can't speak for the entire industry. I only can speak for those members in which that are members of our organization. And so having that minimum, I think, is a responsible matter.
Okay, so you do support a minimum. And Ms. Lee, what percentage of buy now, pay later customers have fallen behind on their payments? There are reports that as many as a third of customers have fallen behind on their payments. Are you aware of those reports?
I would say on the membership in which I represent, 97%, only 97% do not incur, 97% consumers do not incur a late fee.
Okay. Ms. Saunders, Ms. Torres, do you have thoughts on the extent of delinquency in the BNPL industry?
Well, I'll just point out that they secure repayment automatically. So they take your debit card or in some cases a credit card. Some people are paying credit to get credit. So it's easy to collect, and that doesn't mean that it's affordable. But Ms. Torres may have more to add.
This is based on user data. This survey that we're citing was done by Credit Karma, 1,000 users who are reporting that they are not being able to keep up with payments. A third of those 1,000 surveyed so that they were not able to keep up. And as Ms. Saunders pointed out, because they do have direct access to your bank account or a credit card to get that payment, that can pose a number of risks for consumers who don't have that money available to them, such as overdraft, not sufficient funds, which can lead to someone ultimately falling out of the banking system if they're not able to keep up with these payments. So I think that this is definitely another reason that we underscore the reason for CFPB to be taking a look at what the consumer experience is and a comprehensive overview of all of the members who participate in this type of lending.
Ms. Brody, so these fintech cash flow products exist to serve those who have historically been underserved by the traditional financial system. Do these products actually affect the racial and socioeconomic disparities in access to financial services?
They do provide access to banking services that many people don't have or that haven't had as banks move out of their neighborhood. So in that way, they do provide access. I can't particularly speak to how they've changed the racial wealth gap.
Are there any studies that have shown a reduction in access to financial services, a reduction in racial disparities in access to financial services?
Yes, actually, the Brookings Institution is releasing a study in that regard later today that will talk about banks that have been leaving Black neighborhoods and how that has affected savings rates. I cannot speak to how fintech companies have changed that, though.
Okay, so we don't have enough information yet to determine if these products are actually reducing racial disparities in access to financial services.
I don't. Someone may, but I do not. I can speak to the banking part how banks leaving have hurt Black neighborhoods and communities. I can't speak specifically to how fintech companies have helped. I believe that they are, but I can't provide particular data at this time.
Okay. That's the extent of my questioning. Thank you.
The gentleman yields back. Well, I think there's been a very, very good discussion, and it was helpful having a mix of perspectives. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I would just ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to the email address provided to your offices. This hearing is now adjourned. Thank you.
She may have escaped. So she had to leave. Yeah, I'm trying to get a response to see if she's in the office. Great to see you. Thank you, guys. Thank you so much. Yeah, no problem. No problem. Thank you so much. Thank you. Yeah, you can come down to okay.